Hi everyone, I'm Paul, and in today's video we're going to be doing a deep dive into the fundamentals of Bitcoin supply. This is important because one of the major macro investment trends in Bitcoin is the impending supply shock. This ongoing trend has a major impact on the medium and long-term price of Bitcoin, so understanding it is critical for any Bitcoin investor. Let's jump in. For those of you that are new to Bitcoin, we'll just do a really quick introduction. So Bitcoin is one of the most well-known cryptocurrencies and it has a current market capitalization of about 800 billion. Now, the total market capitalization of the whole cryptocurrency market is about 2 trillion. So Bitcoin makes up about 40% of that. But like traditional financial services and traditional financial products, Bitcoin operates on a trustless, decentralized system, and that records transactions on a distributed ledger. And this is what's commonly known as a blockchain. And that's distinctly different from traditional financial services, which relies very heavily on intermediaries like custodians. And the problem with those is that they introduce obviously more inefficiency into the system and cost. And that inefficiency and cost is ultimately borne by the investors. So that's one of the goals of blockchain technologies, is to eliminate a lot of that cost and inefficiency. The idea of Bitcoin came into fruition through a white paper which was penned by Satoshi Nakamoto. Now no one knows who he is or she is, or whether that was a group of people, but that white paper is basically what started it all. And if you haven't read it before, I really recommend it. You can find it on bitcoin.org. And that's, really, fundamental reading to anyone starting in cryptocurrencies. So mining is a really critical part of the whole Bitcoin ecosystem. And the only way Bitcoins can be created or new supply can be created is via block rewards, which are awarded to miners. Now, by design, Bitcoin miners are incentivized to continue to maintain the network, so the security and veracity of the network, by continuing to mine, and they receive new coins or new Bitcoin as a reward for that. So that's how they're incentivized to provide that service to the network. Now, what a miner is when miners started, they were just traditional computers using traditional GPUs, but over time they become far more sophisticated. Miners use really specialized computer rigs to solve a computational puzzle which effectively verifies 1 megabyte of transactions, and that's called a block. And when that block's verified by the other competing miners in the network, it's then added to the blockchain, and that successful miner receives a block reward. Now, this is obviously where the term blockchain comes from, because the blockchain itself is a chronological chain of these blocks, which represents the historical ledger of transactions on the blockchain. So in 2009, when Bitcoin first started, the blockchain reward was 50 Bitcoin. And every sort of 4 years or 210,000 blocks processed, there's what's called a halving. And every time that halving event occurs, the block reward drops. So it obviously went from 50 to 25. And in the last halving, which was in May 2020, that then went to 6.25 Bitcoin. So the basics of Bitcoin supply is that there's only ever going to be 21 million Bitcoin. Now, we haven't reached that at the moment, and according to current research, we're at about 18.9 million Bitcoin. So that's what's already been mined, and that's what's available or circulating in the market. So that leaves about 2 million Bitcoin to be mined, and basically block rewards, and hence new Bitcoin supply, is expected to reach zero by 2140. So by that time, miners won't receive block rewards in terms of Bitcoin anymore. They'll be rewarded in terms of payment for processing the transactions. The halving process itself, that happens every 4 years or every 210,000 blocks, is inherently deflationary, and that's very purposefully built into the way Bitcoin operates, so it's a deflationary asset. Now, only miners can create new Bitcoin or contribute to supply, and so all other participants, if they want to acquire Bitcoin, can only acquire it through an exchange or through a peer-to-peer transaction with another holder. So as we mentioned, Bitcoin supply is capped at 21 million. In the current supply of about 19 million, 60% of that is held by investors, so long-term investors, and those investors have not shown any propensity to sell. So I think the way that stat was kind of created is that they'd sold less than 25% of their holdings over an extended period of time. Now, interestingly, about 20% of the available current supply is thought to be lost because in terms of the analysis of wallets on the exchange, those have been completely inactive. And so there's this estimate that about 20% has been lost. And so what that means is we only have about 20% of the available current supply that's in circulation, that's liquid. And so that's about 3.5 million Bitcoin, and that's all that's available to be traded. So that's a very small parcel of obviously the total available supply. And even if we, zoom out to having that 21 million in supply, you'd expect that 20% figure is probably going to shrink as those investors, those larger investors, to continue to accumulate, or new investors come in, accumulate, and they become long holders also. And so the thing that is driving everything to this supply shock is you have increased adoption happening. You have obviously greater awareness of Bitcoin and its advantages as a deflationary asset. And there's this growing perception that Bitcoin is going to be the internet store of value or digital gold. And it's also seen as a really strong hedge against inflation. So they're all the demand push events that are happening on Bitcoin, and you have this extreme constriction of supply. So these things all come together to create a supply shock. Now, this supply shock is going to play out over an extended period of time. It's not something that is necessarily immediately apparent, but obviously as existing investors and new investors start to fight for that very small liquid available parcel of Bitcoin in the marketplace, that's naturally going to have a very strong effect, a very strong upward effect on price. Now we can see all of these supply and demand factors come together in a number of charts. So I'm going to step through those charts now and just give a quick explanation of what that looks like, and then as you go forward in your investment journey, you can use those charts to observe what's happening to supply in your current time frame. And obviously, if you see a breakdown in this supply-price relationship, you can then adjust your investment decisions accordingly. So we've already discussed how miners are a really important participant in the Bitcoin ecosystem, being the creators of new supply. And so obviously, as the creators of supply, and you'd expect Bitcoin miners to be a fairly sophisticated participant in the ecosystem because they're obviously mining coins and they use those coins to support the business of being a Bitcoin miner. And so they'll be very in tune with when they feel that Bitcoin is either under or overvalued, and they will then choose to move their reserve, their coins, onto exchange and sell them accordingly or keep them in their wallets. And so what this chart shows you is that over a period, now this is about a year of data that I've shown, but you can clearly see the trend, is that over time, Bitcoin miners are keeping coins on their wallet, and very recently, as prices pull back from all-time highs, Bitcoin miners are increasingly holding coins on wallets rather than moving onto the exchange and selling them. So one of the major participants in the Bitcoin ecosystem is keeping those coins in their wallets off exchanges, so again, putting downward pressure on supply. Now, investors are obviously the biggest participant in the marketplace, and ways we can look at how they are behaving in the market is by looking at the on-exchange reserve. So that's just basically how much Bitcoin is sitting on the various exchanges. And when there's Bitcoin sitting on exchanges, you make the assumption that, psychologically people keep their Bitcoin or other coins on exchange because they're thinking about selling them. They want them readily available so that they can sell them, at very short notice. If they're keeping them off exchange, obviously their intention is that they want to keep them off exchange. They don't really have an intent to sell. And so we can see here, since early 2019, that the trend has been very clearly downwards. The number of coins held on exchange is going down. Now, obviously, it's sort of moved up and down as price has come up and down. But very clearly the trend is downwards, and there doesn't seem to be any evidence that that trend's being arrested or it's going to change. Now we can see how this on-exchange trend is actually occurring by looking at the net inflows and outflows. So basically this chart just shows the net effect of inflows and outflows on exchange, and you can see overwhelmingly that the tide is coming out, that there's more coins coming off exchange that are going onto them. And even very recently, so this is videos in January 2022, is that we had 30,000 Bitcoin in one day come off the exchange. And you can see by the history is that kind of big withdrawal, net withdrawal off exchanges is not uncommon. And so we know in aggregate, investors are taking their coins off exchange, they're keeping them in wallets, and whether that's a soft wallet or a hard wallet, their intent is to take them off exchange because they intend to hold them over a longer period and to not sell them. So that trend has been ongoing, and again, there's no evidence that that is going to change. Now, one of the other ways we can look at investor behavior is the distribution of the age of coins. Now, this is all color-coded on this chart, and you can see very clearly that on these very long holder time horizons, so 10 years, 7 to 10, 5 to 7, is that these numbers, or number of coins, is increasing. And so if you start on the left-hand side of the chart and move to the right, you can see that over time, these numbers are increasing, and it's really only on the shorter time frames that you see the sum actually change. So what that says is that shorter-term investors, so investors that are working off a whole period of maybe only 18 months or shorter, are the ones whose investment decisions change the most. Those long-term holders tend to be very static, they net accumulate, and it's only the short-term holders who are moving in and out of Bitcoin. Now, if we look at that trend on a shorter time frame, so the last year, you can see that even more clearly, is that the longer-term holders are very static, and it's only the short-term holders that are moving. And that trend is being consistent all the way through, and so that all builds to this supply shock thesis where we have only a very small amount of the supply at any given time in circulation or available to trade through exchanges. A simpler way of looking at this is the mean dollar age of coins. You can see over time, irrespective of what happens to the Bitcoin price, that the coins held over time just continues to go up. So this trend just shows no sign of stopping. The momentum is very clear in this direction, and so clearly at some point this supply issue will become a really major impact on price. And so that's what the supply shock thesis is all about, is we have all these pressures which are building towards an upward pressure on price because we just have such a limited supply left of Bitcoin that is available to trade on the exchanges, less than 20% of the total supply in circulation. So if we look at some case studies, it's only in fairly recent history that we've seen institutions start to move into Bitcoin as an asset class. Now, the first case study we'll look at is Grayscale. So Grayscale is a more traditional financial institution, and they manage trusts where they create exposure to cryptocurrencies for more traditional investors that can't invest directly into the assets themselves. So you can see here, and basically the story behind it is that the mining activity in the ecosystem can't keep up with the appetite from some of these big institutions. And keeping in mind this is a very new phenomena, we don't have lots of institutions in the market as yet, and already the ones that are in there can very quickly, gobble up all that new supply. And so this data is a little bit old. This is from December 2020, but you can see in that period of December 2020, Grayscale bought almost 73,000 Bitcoin, so added 73,000 Bitcoin to their existing holdings, but only 28,000 was created in terms of new supply by miners. So just by function of their participation, they're going to have an impact on price. Now you can see at that time, Grayscale controlled about $20 billion worth of of Bitcoin. And so they went from about $2 billion worth of Bitcoin the year before. So by the beginning of 2020, they had about 2 billion Bitcoin. By the end of 2020, they had about 20 billion Bitcoin. And as of this video, they've increased their holding to 27 billion Bitcoin. So you can see in a very short period of time, they've accumulated, a very large holding, and they're probably one of the biggest institutions in terms of what's publicly available anyway, that is in the marketplace. So I think that's a really interesting example of how quickly institutions are accumulating when they do enter the market, and also what kind of impact that's going to have. Because remember, they're taking all of those Bitcoins off exchange into cold wallets, and that's now out of supply. So this is all adding again to this whole supply shock theory that is underlying our investment hypothesis in Bitcoin. So the second case study is MicroStrategy, and MicroStrategy is interesting because it's a listed company on the NASDAQ. Now, you may have heard of Michael Saylor. He is the CEO of MicroStrategy, and that's a picture from his Twitter profile. He's got the laser eyes. It's very cool. Reminds me of an awesome NFT. And if you've seen any Bitcoin videos, you'll know that he is very influential and very outspoken in the Bitcoin community. Now, one of the interesting things about MicroStrategy is from a treasury perspective, so that's how they would invest their excess cash as a listed company, rather than going to sort of traditional, debt instruments where they're effectively not earning any interest or maybe negative interest. They made an active decision to switch from that traditional method of investment and to go into Bitcoin. And so they've become one of the first movers in this space, and it's one of the things that's very sort of, unique to their organization. Now, the thing that's really interesting about that is that they only started this strategy in sort of Q3 of 2020. So they've only really been buying Bitcoin for about 18 months. And in that time, they've obviously gone from zero to about 122,000 Bitcoin with a total cost basis of just under 4 billion. So that's obviously quite small compared to Grayscale. Grayscale's 27 billion, I should say. We're only talking about 4. But this just gives you an idea of, now we've got another institution in the market, and this is how they are then participating in the market, and that's the kind of effect they're going to have on supply through that participation. So we can see that supply is becoming an increasing issue. We know that we have most investors, that's being long-term investors, and even the miners themselves, that are taking their coins out of supply and keeping them in wallets. Now, with the amount of coins that have been lost, about 20%, that leaves again only about 20% of the total available supply. So at the time of this video, about 19 million available for trade on the exchanges. Now, due to pressures from increased adoption and interest in Bitcoin, because people are looking at Bitcoin as a digital store of value or as digital gold, or even as a hedge against inflation, there's increased investor activity. And we also know that bigger investors and institutions are bound to either continue to accumulate or enter the market and newly accumulate. There's an increasing demand push, and there's a limited supply. All of this bakes into the theory that we have an impending supply shock, and at some point that is going to create an immense amount of upward pressure on price. Now, if you're liking this video, it'd be great if you could hit the like button. That helps other people to find it, and if you're enjoying this content, it'd be great if you could subscribe to this channel. So now we better understand why there's an impending supply shock in the Bitcoin market. How can we then observe this in effect on both short and longer time frames, and how can we apply it to pricing so that we can better use that to then help us direct our investment decisions? One of the things I find really helpful to do is to overlay price onto the total supply of Bitcoin. Now, what this, allows you to do is to see how the supply acts as this sort of gravitational pull on the price of Bitcoin over time. So regardless of whether Bitcoin really overshoots, so we have a parabolic move to the upside, and that's what we have often at cycle tops in Bitcoin, that eventually we get that eventual crash where we have the price, pull back, and often that's just the effect of the price just getting away from the supply. So it's sort of like a mean reversion, if you like, and that happens to the downside as well. So whilst we might have periods where price can deviate from that supply line for extended periods, like we had in 2020, gravitational pull of supply pulls price back towards that point. And we see that happening again and again. So from my perspective as an investor, every time I see price swing heavily away from the supply line, I just have that understanding that at some point we're going to have that mean reversion and price should start to come back. Now, one of the most famous models for depicting the relationship of the supply shock is the stock to flow model. Now, the stock to flow model applies traditional analysis that is used for commodities like gold and silver. What the stock to flow model shows us is how Bitcoin's price has moved over time, and in this particular chart it shows us that price movement relative to the time towards the next halving event. And you can see that every time that the Bitcoin price moves away from the stock to flow model, it invariably moves backwards. And the stock to flow model is one of the reasons why you hear in the Bitcoin community people use particular price targets, like especially that $1 million per coin target, is because this stock to flow model has been one that's been used quite extensively over the sort of whole Bitcoin evolution, and it's one that investors use and track quite keenly if they're following this theory of a supply shock. And one of the things I think is really interesting about this model is you see as we approach very closely to that halving event, we tend to gravitate quite close towards that model price, the stock to flow model price, and then immediately after that halving event you see price generally accelerate away. I find this model really helpful because when price deviates too far from the model, that can either tell you that it's a good time to accumulate more Bitcoin if the price is well below what the model price is, and on the other side is if the price has deviated way too far to the upside from the model, is that you may be in danger from a top, or that might be a time to lighten some of your exposure to Bitcoin with the anticipation again that we'll have that mean reversion back to the supply line or back to the stock to flow model predicted price line. So to summarize, we know that Bitcoin's total supply is capped at 21 million and the current supply in circulation is about 19 million. And of total supply, we know about 60% of that is held by both miners and investors off exchange, and they're holding that with a long time horizon and don't really show any real impetus to be selling any of those holdings. Of the remaining supply, we anticipate that up to 20% of that is lost, and that's been lost because those people have lost the wallets or they've lost the keys to those wallets, and so that potential part of supply is just gone forever. And so that only leaves about 20% of total supply available to be traded on exchange. Now we know that we have increasing demand push because we have more investors coming into the market because there's greater adoption of Bitcoin as an investment class, and that's driven by people's perception that Bitcoin is a digital store of value. It could be seen as gold of the internet, and increasingly people see it as a hedge against inflation. And so all of these factors are driving that demand push, and we know we have an extreme contraction of supply in terms of what's available on exchange to be bought. So all of these factors conflate to create upward pressure on price. Now, this can occur at different points in the market and is all driven by that demand. And so over time, what you would expect to see as more participants come into the market and that supply continues to dwindle is that you're going to have that restriction in supply creates that supply shock, and we'll get that really strong upward pressure on price. And this is fundamentally what the whole supply shock hypothesis is all about. And you can see very clearly that there's lots of evidence that this is happening over time, and it's one of the reasons why I have a very bullish long-term view on Bitcoin, and many others do as well. So there you go. There's a summary on supply shock and why that should be important to you as a Bitcoin investor. I hope you found that helpful. If you did, it'd be great if you could like this video and subscribe to this channel. I try and produce content like this regularly, and I hope to see you in the next video.